The line just broke. Every analyst, every institution, every paper-shuffling bank told us $65 was the absolute ceiling, the immovable line, the point where their entire system held. December 17, 2025, the market obliterated it. We didn't tap $65 and retreat. We shattered it. Silver hit $66.50 earlier today. Right now, we're at $65.80. And I know exactly what you're thinking. You see that drop from the high, that 70 cents fall. Fear is setting in. You're wondering if the top already happened. If you just watch the peak come and go, stop. What you're watching is not collapse. It's confirmation. This pullback is the single most critical technical signal a breakout can give. It's called retesting breach. We're going to dissect why the price exploded to $66.50 in minutes. We're going to expose the gamma mechanism that forced banks into involuntary buying. And we're going to prove why this pullback to $65.80 isn't weakness. It's structural reinforcement for what comes next. Straight vertical moves end in crashes. Pullbacks that hold build launch pads. The $65 barrier is gone. Now we defend what's left of it. To understand how silver jumped from $64 to $66.50 this fast, you need to see the machinery underneath. Gamma measures how rapidly a market maker's exposure shifts. These market makers sold call options at the $65 strike, millions of ounces worth, bets that silver would rise. Below $65, those bets expired worthless. The house collected. But the second silver crossed $65, every one of those contracts started bleeding the banks. Not gradually, exponentially. At $65.10, their systems registered critical exposure. To prevent catastrophic loss, the algorithms auto-bought silver futures. They weren't believers. They were hedging. But their buying shoved the price to $65.30, which increased their risk further. So the computer bought more. Price hit $66. This is gamma squeeze mechanics. A forced feedback loop with no human override. The same system that sent GameStop to $400. This isn't about fundamentals or supply curves. It's pure math eating itself. This morning, the math broke the banks. The spike to $66.50 was algorithmic panic buying to close exposure. A vacuum move, no sellers. Just desperate machines trying to cover. So why did it stop at $66.50? Why are we back at $65.80? Because human traders saw the vertical line and took profit. The gamma burn exhausted. We returned to equilibrium, but the damage is permanent. The $65 level is breached. The psychological ceiling is shattered. And the market makers now understand the system can be forced. They know they bleed. This is where it turns dangerous. Look at the current price. $65.80. Amateurs see a drop from $66.50 and call it weakness. Professionals see validation. There's a rule in technical structure. Old resistance becomes new support. For months, $65 was our ceiling. Every approach, every test, every attempt ended in rejection. It was concrete. Today, we broke through. Now we're standing on top of it, testing if it holds weight. This pullback to $65.80 is the market checking the new floor. We need buyers here. We need the price to hold above $65 through the close. If we stay above $65 today, it confirms the breakout is structural. It signals to every participant that $65 is no longer the exit. It's theme tree. But here's the warning. If the price drops back below $65, if we close at $64, that's a false breakout. It means sellers still control the structure. And false breakouts precede violent crashes. So $65.80 is contested ground. We have 80 cents of buffer above the critical line. Do not celebrate. We need to see the daily close. We need proof the old ceiling can support the new price. This window is already closing. Remember the whale from last week? The entity that absorbed $650 million at $63? Everyone asked if they dumped at $66.50. if they unloaded into the spike. I've been watching the order flow all morning. The whale is still positioned. When price dropped from $66.50 to $65.80, massive block orders appeared on the bid. Someone stepped in at $65.75 and said they'll take it all. This tells you everything. Smart money views $65 as cheap. Last week, they thought $63 was cheap. Now they're defending higher ground. This isn't speculator behavior. Speculators sell into strength. This buyer is supporting weakness, putting a floor under the market to prevent collapse back below $65. Why? Because they know what's next. They know if $65 holds, the next target isn't $66. It's $70, then $85. They're building a base camp, securing territory before the next advance. When you see $65.80, don't see loss. See consolidation. See the big players reloading. The gamma squeeze was ignition. The retest is fuel. But the fire comes from the shorts. The commercial banks, J.P. Morgan, Bank of America, have been short silver for years. They sold paper contracts to cap the price. But at $66.50, their losses went critical. We're hearing rumors, unconfirmed but persistent, that a major U.S. commercial bank started closing its short position this morning. We're going to calculate exactly how much the banks lost in the last 4 hours. We're going to show why short covering acts as rocket fuel. And we're going to explain why this exact price level, $65.80, sits at the pain threshold that could trigger systemic margin calls. The banks aren't fighting us anymore. They're fighting for survival. This is where the system breaks. Look at the commitment of traders report. The commercials, code for bullion banks, are net short roughly 80,000 contracts. One contract equals 5,000 ounces. That's 400 million ounces of silver they've promised to deliver but don't own. They sold it on paper hoping to buy back cheaper. They sold at $50. They sold at $55. Today, it's $65.80. Every single contract is underwater. This is a trap with no exit. When you're long, the worst outcome is zero. When you're short, the risk is infinite. If silver hits $100 or $500, the bank owes that number. There's no ceiling on the loss. At $66.50, risk managers woke up. They looked at the exposure. They looked at the empty vaults. And they realized they were sitting on a loss that exceeds quarterly earnings. This forces behavioral change. Usually when silver rises, banks add shorts to cap it. But today they can't. Their credit lines are maxed. Instead of adding shorts, they have to close them. And closing a short requires buying. You become a forced buyer. You compete with Tesla. You compete with the whale. You compete with retail. You don't care about price. You want out. This creates a permanent bid under the market. A trampoline. Every dip gets bought by a bank trying to cover a few thousand contracts. This is why $65.80 is holding. The banks are consuming their own tail. Let's quantify the pain. For every $1 silver rises, the commercial short position loses roughly $400 million. Since $60, silver is up almost $6. That's $2.4 billion in paper losses. But it gets worse. That assumes they can cover at current price. They can't. If they tried to buy back 400 million ounces right now, price wouldn't stay at $65. It would jump to $100 instantly. This is slippage. The act of exiting makes the exit more expensive. The real loss isn't $2.4 billion. It could be $10 billion, $20 billion. It's a black hole on the balance sheet. This is why $65 was the Maginot Line. Above this level, losses become visible to shareholders. Above this level, bank CEOs get calls from regulators asking if they're solvent. We're watching a slow-motion car crash. Banks are trying to exit gracefully, cover slowly, quietly, without spiking price. But the whale isn't letting them. The whale is absorbing supply. So banks are forced to bid higher. This is short squeeze dynamics. It's not just price rising. It's wealth transfer from the entities that suppressed price to the entities that liberated it. Every dollar up is $400 million moving from Wall Street to Main Street. How do we know banks are capitulating? How do we know they aren't reloading for another smash? Open interest. Total number of open contracts. In normal markets, when price rises, open interest rises. In short squeezes, price rises while open interest falls. Why? Because shorts are closing positions and leaving the game, taking their ball, going home. Later today, when the exchange releases Wednesday's data, watch that number. If price is at $65.80 and open interest has dropped significantly, that's the smoking gun. It confirms the rally was driven by bank exits. This is the most bullish signal possible. It means permanent sellers are gone. Once shorts are closed, who's left to sell? Nobody. Selling pressure evaporates. Price floats to its natural level. But I need to warn you, banks are wounded animals. Before they fully capitulate, they might try one last move. They might dump massive paper at 2 a.m. tonight to trigger panic selling. They want to see if they can shake you one final time. If we see a sudden drop to $64, do not assume the rally is over. Assume it's the death throes of the short seller, their final attempt to create liquidity so they can exit. Unless we break below $61.50, the trend is intact. Capitulation is a process, not an event. Once this starts, it doesn't stop cleanly. So banks are trapped in paper nightmares, losing billions, trying to cover. But while they play paper games, the physical world is running out of runway. The spike to $66.50 wasn't just gamma or short covering. It was desperation, real industrial desperation. We are going to expose the physical disconnect. We're going to show that major industrial users are paying $70 per ounce right now just to secure metal. And we're going to examine the dealer market where premiums are rising even as spot consolidates. The paper market is broken. The physical market is taking over. We need to talk about the $70 secret. If you're only watching the ticker, you're missing the real story. You see $65.80. You see candles flickering. You think that number represents the value of silver. It doesn't. It represents the value of a paper promise to deliver silver in New York next month. But if you leave the screen and enter the real world, if you call a refiner, if you try to buy a monster box of Eagles, you enter a completely different reality. While banks fight to keep paper price under $66, major industrial users are quietly paying $70 or more just to secure delivery. This is the shadow price. The price Samsung pays to keep the factory running. The price the U.S. Mint pays to get blinks. And it's the only price that matters long term. The paper market is a distorted mirror. The physical market is the object. Right now, the object is moving much faster than the reflection. Why would industrial companies pay $70 when the screen says $65.80? Reliability. You run a solar panel factory. Your assembly line costs $1 million an hour to operate. If you run out of silver paste, the line stops. You lose millions. You call your supplier. They say we can get you silver at the COMEX price of $65.80, but it takes 3 weeks. Or you can pay $70 and we ship from emergency reserve today. What do you choose? You pay the $70. You pay the premium because the cost of metal is nothing compared to the cost of stopping the factory. We are seeing reports of this premium buying exploding across supply chains. Electronics manufacturers are bypassing exchanges entirely, going directly to means, directly to refiners, offering cash bonuses to jump the line. This creates a shadow market. Volume moves off exchange. It doesn't show up on COMEX volume bars. Doesn't affect spot price immediately, but it drains physical inventory at alarming speed. While banks trade paper back and forth to manage the chart, real silver is being vacuumed up by industry at much higher prices. Eventually, this disconnect snaps. When COMEX runs out of metal to deliver, spot price has to gap up to meet shadow price. That's when you see silver jump $5 in a single morning. We are currently in that gap. The screen is lying. The invoice is telling truth. Look at the retail market. Go to any major online dealer right now. Check the premiums. Usually when spot rises fast, premiums compress. Dealers want to move inventory. But today, spot is up and premiums are up. Why? Because dealers are scared they can't restock. They sold you a coin yesterday at $63. Today, to replace that coin on their shelf, they might have to pay $65. They're bleeding capital. So they widen the spread. They charge you $65 plus $10 premium. They make the ask $75. They're effectively discouraging you from buying unless you're desperate. Or they switch to pre-order. Ships in 4 weeks. You know what that means? They don't have the silver. They're taking your money today hoping they can find silver in a month. You're giving them an interest-free loan. This is dangerous. If price goes to $80 in 2 weeks, the dealer might default on your order. They might refund your $65 and say sorry, couldn't source the metal. You get your depreciating cash back, but you missed the move. This inventory squeeze at retail level is the canary. When dealers stop selling, it means wholesalers stop selling. When wholesalers stop, refiners stop. The chain is seizing. If you see $65.80 on the screen, do not assume you can buy silver for $65.80. The entry price for physical ownership is practically $75 or $80 right now. The discount window is painted shut. This brings us to force majeure. We talked about industrial buyers paying $70, dealers charging $80. But what about paper holders, ETF investors, unallocated account holders? They're holding contracts that say we owe you silver, but there's a clause in almost every one of those contracts. It says if we cannot deliver metal due to market disruption, we reserve the right to settle in cash. We're getting dangerously close to that trigger. If shadow price is $70 but spot is $65, banks would rather pay you $65 cash than go buy $70 silver to give you. It's cheaper to default. If we see a wave of cash settlements begin, it's game over for the paper market. It destroys trust. Investors will take that cash and rush into physical, driving premiums even higher. This is the feedback loop of doom for fiat pricing. Shortage leads to premiums. Premiums lead to cash settlement. Cash settlement leads to physical panic buying. Panic buying leads to higher premiums. We're in early stages of this loop right now. The $65 breakout was the signal. The inability to source metal at that price is confirmation. If you hold paper, you're betting the system holds together. If you hold physical silver, you're betting the system breaks. Looking at the spread today, the system is already cracking. And this window is already closing. We have the technicals. We have bank losses. We have physical disconnect. The math is on our side. Geology is on our side. Industry is on our side. But there's one enemy left: your own mind. The next few days will be psychological torture. Volatility will increase. Headlines will get scary. Banks will try to shake you out one last time before price goes to triple digits. I'm going to give you mental armor. I'm going to show you how to survive the volatility. I'm going to explain price targets for the rest of the week. And I'm going to leave you with a strategy to ensure you don't sell your winning lottery ticket for the price of coffee. The wall is down. Open field ahead. Don't trip on the finish line. We've reached the final chapter. We analyzed breakout mechanics. We counted billions in bank losses. We exposed the secret $70 shadow price industry is paying right now. But now we zoom out. It's easy to get lost in minute-by-minute combat. Easy to stare at $65.80 and wonder if it holds for the next 10 minutes. But if you do that, you miss the history being made. Today, Wednesday, December 17, 2025, marks the end of an era. The era of cheap silver is dead. The era of managed prices is dead. We've entered the era of price discovery. This is terrifying and exhilarating. In price discovery, there are no maps, no resistance levels because we're trading at numbers that haven't been seen in a generation. The market is trying to find the price that balances massive physical deficit with exponential monetary expansion. And the price is not $65. It's not $70. It's multiples of where we are today. I'm going to give you the psychological tools to survive the next leg. I'm going to show you why $65 is actually cheap when adjusted for inflation. And I'm going to leave you with the final strategy to ensure you don't sell your winning ticket just as the party starts. The wall is down. The open road lies ahead. The biggest enemy you face right now isn't JP Morgan. It's vertigo. When asset price moves this fast, when it breaks all-time highs and enters blue sky territory, human beings get dizzy. You look at your portfolio. You see green numbers. You see gains that used to take years happening in days. And your brain screams this can't be real. It must crash. Take the money and run. The banks know this. They rely on it. They know retail investors are weak hands, not because they lack money, but because they lack conviction. In coming days, expect volatility to spike. We might see silver drop $3 in an hour, rip up $5 the next hour. This is designed to induce motion sickness. They want you so stressed it'd be the swings that you sell just to sleep at night. Do not give them that satisfaction. Volatility is the price of admission for generational wealth. If you sell now at $65.80, where do you go? Back to the dollar, the currency losing 5% of its value per year? To the stock market trading at historic valuations? You have to realize silver isn't just going up. The dollar is going down. Silver is the mirror reflecting collapse of the fiat currency system. Do not sell the lifeboat to buy a ticket back onto the Titanic. Turn off the screen. Stop watching the 1-minute chart. Look at weekly. Look at monthly. The trend is vertical. Momentum is unstoppable. Let the market do the work. But $65 is expensive. I hear this constantly. People think because silver was $20 a few years ago, $65 must be a bubble. Look at the data. In 1980, the Hunt brothers squeezed silver to $50 an ounce. All-time high. But $1 in 1980 bought far more than $1 in 2025. If you adjust that $50 high for official CPI inflation, that $50 equals roughly $170 today. Think about that. To simply match the purchasing power of the 1980 high, silver needs to nearly triple from here. At $65, silver is trading at a 60% discount to its inflation-adjusted high. It's the only asset class on the planet this cheap. Stocks are at all-time highs. Real estate at all-time highs. Art at all-time highs. Silver is still recovering from a 40-year bear market. When you feel like $65 is too high, remember you're buying the most undervalued asset in human history. We're not at the top. We're barely off the bottom. This perspective is your shield. When media screams bubble, you look at inflation math and smile. The bubble isn't silver. The bubble is the dollar. This leads to the final question. When do I sell? If we're going to $100 or $170, at what point do you cash out? Here's the secret of the wealthy. You never sell for cash. Cash is a melting ice cube. You only sell to swap. You swap an overvalued asset for an undervalued asset. Right now, silver is undervalued. Eventually, at $100 or $200, it might become overvalued relative to other things. Watch the gold to silver ratio. Right now, it takes roughly 70 ounces of silver to buy 1 ounce of gold. Historically, that ratio averages around 40 or 50 to 1. In 1980, it hit 17 to 1. If the ratio drops to 30 to 1, that's your signal. You swap volatile silver for stable gold. You effectively double your gold stack for free without ever touching a dollar. Or you swap for real estate. In 1980, you could buy a median home in America for roughly 800 ounces of silver. Today, at $65, you need roughly 6,000 ounces to buy a home. Wait for that ratio to close. When you can trade a monster box of silver for a down payment on a farm, that's the exit. Do not trade for numbers on a screen. Trade for acres. Trade for ounces of gold. Trade for cash flow. That's how you lock in wealth transfer. We've covered enormous ground today. The breakout, the gamma squeeze, bank losses, physical disconnect, and now psychology. Wednesday, December 17, 2025. We will look back on this day as the tipping point, the day banks lost control, The day the $65 wall fell. The genie is out of the bottle. You cannot put toothpaste back in the tube. The world now knows silver is scarce. They know the price was suppressed, and they're rushing to get a seat at the table. You're already seated. You saw this coming when everyone else was asleep. Now your job is simple. Do not move. Do not sell. Let the market come to you. The squeeze has just begun. Hold fast.